Welcome to today's Capital Securities morning briefing. Let's dive right into today's key topic. A major market shock may be imminent. Over the long weekend here in Taiwan, US markets showed notable weakness, with significant losses across major indices on Thursday and Friday. This pullback was largely triggered by former President Trump's aggressive tariff proposals, which have reignited global trade tensions. Investors should brace for a heavy impact on the Taiwan Stock Exchange, TAIEX, and individual stocks today. A return to high tariff era, century-high trade barriers. Trump's proposed average tariff rates are now tracking levels not seen since the early 20th century, marking one of the most protectionist stances in modern US economic history. Since the boom of globalization in the late 1990s, global trade has relied heavily on international cooperation and supply chain integration. However, the US appears to be retreating back into economic isolationism, bringing fresh volatility to global markets. While many had expected Trump's tariff talk to be a negotiation tactic, the actual measures are turning out to be much more aggressive than anticipated, posing real threats to global stability. Market Impact Preview. Looking at the period from April 2 to April 4th, FTSE Taiwan futures dropped 9.18%, including a single-day drop of 5.03% on Friday alone. This suggests that the TAIEX is likely to see a comparable drawdown. Market estimates point to a potential drop of 1,600 to 2,000 points. Investors holding index futures or large-cap positions should be extremely cautious, as limit-down risks are on the table. TSMC, a market bellwether, saw a 6.72% drop on Friday, with a two-day combined loss of nearly 13.84%. This adds to the evidence that Taiwanese equities will likely open significantly lower today. Global backlash, retaliatory measures, and political discord. While Taiwan has chosen a non-retaliatory stance, President Tsai addressed the nation yesterday to reassure the public. The global response has varied widely. European Union, mixed strategies are emerging. While France and Germany favor retaliatory measures, countries like Italy and Spain advocate restraint. The lack of a unified EU position threatens to undermine the bloc's credibility and raise doubts about its long-term political cohesion. China has mounted the strongest response so far, announcing a 3 to 4% tariff hike on US origin goods starting April 10th. More significantly, China imposed export restrictions on 7 rare earth elements, critical materials in US aerospace and defense technologies. This targeted move underscores China's strategic leverage. Trade between the two economic superpowers is already shrinking. China's exports to the US have fallen below 17%, and US imports from China are now under 8.5% of total volume. Both sides are actively decoupling, with China redirecting exports towards Southeast Asia and other regions, while bolstering domestic demand through fiscal stimulus and infrastructure spending. Macro implications from recession risks to rate cuts. Leading investment banks, including JP Morgan, now forecast that the US may enter a technical recession by Q4, with 2025 GDP projections revised downward to 0.3% from a prior estimate of 1.3%. This has fueled expectations for aggressive Fed rate cuts. Markets are now pricing in up to 6 cuts by year-end, with the Fed funds rate potentially dipping toward 3% by March 2026. U.S. employment remains a focal point. While the March non-farm payrolls beat expectations with 228,000 jobs added, much of that upside came from temporary rebounds in weather-sensitive sectors like leisure and hospitality. The unemployment rate ticked up to 4.2%, and if trends continue, we could see levels as high as 5.3%, further pressuring the Fed to act. Yield movements and safe haven demand. Despite the jobs data, U.S. Treasury yields saw only modest rebound. Investors remain risk-averse, flocking to safe haven assets like Treasuries and German bonds. The VIX volatility index doubled, surging past 40, signaling that markets are entering high alert territory. Bond investors who were previously underwater are now seeing opportunities to rebalance toward fixed income. Given the rising risk of economic contraction, allocating more toward bonds appears prudent. Sector highlights and international spillovers. While global markets sank, the Dow dropped 9.26%, Nasdaq slid 11.15%, and SOX Semiconductor index tumbled 16.74%. There were a few bright spots. Some Vietnam-based manufacturing stocks saw short-term gains, thanks to speculation that Vietnam might be exempt from new US tariffs. However, these rallies are likely temporary until formal policy confirmation. Europe's Stoxx 600 index fell 5.12%, erasing gains from earlier in the year. Japan's Nikkei declined more modestly on a daily basis, but saw consistent 2 to 3% drops throughout the week. Interestingly, the US dollar index dipped initially, despite rising geopolitical risk. However, demand for the dollar later rebounded, reflecting its continuing status as a safe haven, at least for now. Key takeaways for investors. Today, brace for impact. Taiwan markets are expected to open sharply lower. Watch for limit down scenarios on major indices and large cap names. Risk management. First, if you're holding index futures or highly volatile stocks like TSMC, now is the time to review your stop-loss strategy or hedge using options. Favor fixed income. With recession risks rising, shifting portfolios toward bond-heavy positions is advisable. Don't chase the bounce yet. Refrain from bottom fishing in today's session. Markets need time to reprice geopolitical risk and policy responses. Monitor US CPI. This week, while the economic calendar is light, inflation data will be crucial in determining the Fed's next move. We'll continue to monitor developments closely. Stay tuned, stay hedged, and stay safe.